The global growth, I think, is far more positive than people anticipated, right? For lots of reasons, and not just China, as Luke said, but across the region. Right?
The outlook for copper, from our perspective, is quite positive. Not only do you have that backdrop around demand that I touched on earlier, you've also got a range of newer related demand areas, and in electric vehicles in particular.
China gets 70% of its iron ore, seaborne iron ore, from Australia. The steel sector is absolutely vital to their economy. I mean, can you imagine what would happen to China's economy if they couldn't make steel anymore?
Well, hello, welcome to One-to-One Mining Investment APAC. Delighted to see you here today for our webinar on Commodities Outlook, Expectations Beyond 2021. Now, before we get started, I just want to remind everyone that we have our one-to-one meetings taking place on the 16th to 18th of June. That's a little bit over a month's time. So next week on Tuesday, I believe, we'll be opening our meeting planner. So if you are an investor and you haven't signed up for the event yet, please do visit our website, Google One-to-One Mining Investment APAC, sign up, register there, and we will send you logins to the meeting planner where you'll be able to choose from around 60 companies from the TSX and the ASX for you to set up one-to-one meetings with. But today we're going to be talking commodities. We're in the middle of what appears to be a bit of a raging bull market for commodities, and we've got a great panel here to tell you what's going on and what to expect maybe next. We have Jason Chang, who is the CEO and Managing Director of EMR Capital. Jason is here in Hong Kong. We have Clyde Russell, who is the Asia Commodities and Energy columnist for Thomson Reuters. Clyde is based down in Tasmania. And we have Luke Smith, who is Portfolio Manager, Global Resources at Ausbil Investment Management, based in Sydney. Great to see you today, folks. I'd like to just start things off. What's going on? If you look at most commodity prices, iron ore, copper, I was looking even today at sort of soybeans and corn, they're all at record sort of highs. Since the sell-offs last year in February, March, we've seen a steady uptrend, and now we've got iron ore, spot prices for delivery in China up about sort of 230. We've got copper over $10,000 a ton. What's happening? What's causing this? Clyde, we start with you.
Yeah, look, it's as is always the case with these things, there's more than just one thing working in tandem. One, you have still quite a lot of cheap money floating around the world looking for investment opportunities. So you've got hot money flows, and commodities are hot, so you've got that. You do have, or at least have had, very strong Chinese demand for certain commodities, particularly the iron ore feeding into their massive steel industry. Then you've got the copper as well. We have seen copper come off a little bit on the Chinese demand side in the last couple of months, but it's been taken over by surging demand in other parts of the world. So you've got this positive China background. You've got an increasingly positive European, North America background, looking at as those economies come out of COVID. You have got a few negative things floating around, as in India. There's still a little bit of uncertainty about how quickly Asia will open up. But overall, you've got a very positive background. And then on the sort of supply side, it's no surprise to me that the commodities that are actually rallying to the highest prices. I mean, iron ore is, if you'd said to me at the beginning of the year, by May, iron ore would be $230 a ton, I would have said, can I have what you're smoking? Because I just wouldn't have believed it. But what I have seen is that there's still constrained supply out of Brazil. Their exports are still well short, 5, 6, 7 million tons a month short of where they can be. And you had a cyclone hit WA earlier in April, and that constrained a bit of exports out of WA. Again, not a huge drop, but just enough to tighten that market. It's the same situation with copper. You've had labor unrest and issues in Chile. There's also now a growing realization that the world just doesn't simply have enough copper, and that the incentive price will probably have to rise quite dramatically to encourage people to actually build new mines or explore. So you have these a sort of really good combination on a bunch of commodities, and those are the ones that are doing really well.
Absolutely. And what about the idea that this is a symptom of inflation? That what we're seeing is too much money printing, and inflation is the cause of these spikes.
Do you want me to jump in there, Leo? Yeah, so what you're highlighting is another one of the factors, right? And I'd probably expand on what Clyde was saying, and it's always dangerous when someone says, the difference, this time it's different. What is different about this cycle? And the difference this time around is not just China. Is 10 years ago the cycle that we saw in resources, and the bull cycle that we saw that sort of ended towards the early part of this decade, last decade, was really dominated by Chinese demand growth, and Chinese demand is sort of the backdrop to everything. It sort of dominates sort of roughly 50% of commodities demand in general. So it is core. It is strong. It's sort of it's come out of COVID issues in the first quarter of last year, and really sort of accelerated through the course of last year, focused towards probably more construction related commodities. Steel, cement, iron ore as a result, met coal to a less degree given the issues there, right? But what's starting to flow through, and I guess coming back to your question around stimulus and the inflation that's coming through in stimulus is that the rest of the world's starting to come to the party as well, and that's probably something that we haven't seen in some time in this market. The vaccine starting to have a real impact. You wouldn't realise it from focusing on the mainstream media, but the implications of the vaccine in US in particular, and what that means for pent-up demand that we've seen over the last sort of 12 months, in terms of the restock in some of these commodities or products in general, combined with your point around accommodative monetary and also fiscal stimulus, is really setting a very positive backdrop for the demand environment. That some of the points that Clyde mentioned around supply through the course of the last year really weren't in a very strong demand backdrop for some of these commodities. Is that through the course of last year, sure, there was a strong and improving demand backdrop, but really this year it's been about the release of the rest of the world, the combination of unprecedented levels of monetary stimulus, an increasing amount of fiscal stimulus, which is now able to hit the ground, and that's just talking about the demand backdrop before you start expanding on what's been playing out in supply as well, which Clyde touched on.
I mean, one thing that has been mentioned is the impact that lockdown has had on consumer spending patterns. That people during lockdown have been spending more money on goods and less money on services. So they haven't been going on holidays. They haven't been going to the theatre or whatever. They haven't been going to restaurants, but they've been buying, sort of exercise bikes, and they've been buying new TVs, and they've been having extensions put on their house and things like that. How much do you think that plays into the rise in commodity prices, or is that just a minor issue? Clyde,
I can start on that, Leo. I think it's clearly an element. I mean, we're seeing even in that situation, Leo, we're seeing the market moving to property in regional country and not just in the center. So that I think promotes construction and the demand for materials. So I think that is an element, as well as goods, Leo. But in terms of raw materials, property obviously is a key driver. But we are seeing the pandemic, I think, giving rise to property demand beyond the city center, and hence the demand in sort of these raw materials. But fundamentally, I think it is a demand-supply equation, right? As Luke and Clyde pointed out, end of the day, I think for us in the supply side, we've always had a view around demand, but I think the pandemic actually have made this a bit more acute. And also the global growth, I think, is far more positive than people anticipated, right? For lots of reasons, and not just China, as Luke said, but across the region, right? Across Southeast Asia, South Asia, Europe, and US. I think you're going to see better numbers. And couple that with stimulus, demand is strong and stronger than anticipated. But I think the other side of the equation is supply. I mean, I think this pandemic has also shown the potential disruption and difficulties in getting supply, even in a normal environment, pre-pandemic. But I think people are now becoming far more aware that supply is even more constrained. So you put that together. I think that's what's driving this sentiment around some of these core commodities.
And do you think also that the pandemic has highlighted the need for people to have more robust supply chains? So we might see people trying to sort of, get control of their own supply chain. So kind of have more parallel supply chains set up going forward. And that sort of ties in also with sort of increasing nationalism, resource nationalism going forward, which could also drive that further.
Yeah, I'd probably agree with that, Leo, that some of what's changing in terms of the supply chain, effectively China's been exporting disinflation for the last 10, 20 years, and potentially with a shift away from China, around some of the political focus that we've seen over the last 12, 18 months, potentially, that feeds into this inflation discussion as well. And you start seeing a move to broaden up the supply chains. Potentially that feeds into a discussion around inflation as well, which ultimately feeds into a discussion around commodities more broadly. Clearly commodities perform well in an inflationary environment. It's sort of a bit of a circular reference, given that to some degree that they're causing the inflation. Oil is a big driver for inflation, grain and ag, clearly as well. But some of the changes in the supply chain quite interesting for what they mean for an inflationary backdrop that we're going to see play out, or potentially see out over the next 12, 18 months as well. And I guess the other component to it as well, and it's something that is sort of highlighted in a prior comment, is that we've seen a major restock of supply chains as well. Is that some of what played out through COVID was just working hand to mouth around supply chains, but you can see it in the container shipping market. Ability to access containers really highlights what's happening in terms of a restock of the broader supply chains and the pent up demand that has been in place for as we've worked through COVID as well.
Absolutely. At this stage, I'd just like to remind the audience that we will be taking questions from you at any point during this webinar. So if you'd like to ask a question either about the general market or a specific commodity, please do drop it into the Q&A box at the bottom of your screen. Just type your question in there. If you can use the Q&A box rather than the chat, it keeps it all in one place. So type your questions into the Q&A. We also have some questions from the audience which we collected in the run-up, but please do ask your questions at any time. But my next question to the panel is really where next from here? If we were thinking about the commodity cycle as a clock, how close or far away are we from midnight? Clyde, where are we in the cycle?
I think, unlike the last sort of, if you could say, the recovery from the 2008 financial crisis, which, as Luke said, was a largely China-driven thing, and it did tend to lift all boats more or less equally. I don't think that's going to be the case in this cycle. I think what you've got is quite a differentiation between commodities that are going to be big winners, some that will be winners, but not massively so, and others that could well end up being losers. It all depends. I don't want to, dish on coal enough people do that already. But coal is shaping up as a particularly thermal coal as a commodity that's going to struggle in the coming years, notwithstanding the fact that there's still quite strong seaborne demand in Asia. It's not a growth story anymore. It's really just meeting the existing demand. You also have the disruption to a whole lot of things because of the, how can I put it tactfully, the fight between China and Australia. I tend to look at this as two little boys playing in the sandpit and not sharing nicely. I think there's a complete lack of maturity on both sides. But that is driving a lot of disruption across Asian commodities. I mean, you have Australian coal no longer goes into China. They're paying double the money for Russian coal of a similar quality, double the money for coking coal from America. You've got the Indians buying thermal coal from Australia. They never used to do that before. You've now got some hints that the Chinese might actually start limiting LNG imports from Australia. Obviously, the big daddy is iron ore. They're not going to touch that yet. Certainly, they'd have to build up a massive stockpile, and they're not in that situation. But if I was looking at what I think is the commodities that are going to do best, you've got to look for the ones where the demand story is strong and the supply story is constrained. Now, there's quite a few in that category. The most obvious candidates and the big ones are iron ore, to a lesser extent steel, but copper as well. But you're starting to see a certain level of constraint emerging in aluminium as well, and things like that. So you've got to look for the commodities where supply can't be brought on rapidly. And that definitely is copper. Even to extend to iron ore, a lot of what the mining giants are doing is replacing capacity that's leaving the system with new capacity. So they're building mines to replace expiring mines. Yes, you've got the big project in Guinea, but that's still several years away, at best, if ever. That's a very interesting, tricky project in many ways. So I think you've got to look for that sort of idea of where am I going to see constrained supply, where am I going to see strong demand, and then sort of work out, everything else, how that fits in. Certainly, commodities that are artificially constrained in supply, like crude oil currently, you wouldn't be saying that that's a long-term bull market, because, the supply can come back fairly easily, and it will come back no matter what OPEC and its allies try to do. So, I still think in some ways the key is, if we assume that demand is going to be strong globally, look for the commodities with the least amount of supply flexibility.
Absolutely. Just to touch on your point about China and their sort of veiled threat possibly to ban iron ore from Australia. If you were a betting man, what sort of odds would you place on that?
Zero. Absolutely zero. China gets 70% of its iron ore, seaborne iron ore, from Australia. The steel sector is absolutely vital to their economy. I mean, can you imagine what would happen to China's economy if they couldn't make steel anymore? It would just come to a crashing halt. So the chances of them actually acting against Australian iron ore is minimal. It's Australia's big weapon. It's the nuclear option. If our somewhat, again, I've got to be tactful what I say, immature politicians decide that chest thumping is more sensible than talking. I mean, we could restrict iron ore exports to China. That would be, I think almost tantamount to a declaration of war. But, that's, the one thing that Australia has. What I think is going to happen on this ongoing fight is, until you get a new government in Australia or some mechanism that you can reset, because you're not getting a new government in China, and they'll be very reluctant to back down or change their positions, because that's not generally what authoritarian regimes are known for. So the reset is going to have to come from the Australian side. I think it would be better, that's best achieved with a change in government. That's not a certainty right now. The current Prime Minister's party is still favoured to win the next election. But you never know. Things can change, things can develop. But I think what you're going to see is they're going to start sniping around the edges. They've already disrupted coal. They'll look at LNG, and they'll keep doing all those little things that are of great importance to people in those industries, like lobsters and wine, but on the greater scale of things don't really matter. But I mean, right now, China is giving more money to Australia than it ever has. I mean, so if they're really trying to hurt Australia, they're not actually succeeding.
Absolutely. If we can move on to copper. Jason, bring you in here. Your thoughts on the outlook for copper. Clyde mentioned that it's possible to bring on supply in that sector. What are your thoughts on where that market's going?
Yeah, supply side, it is tough to find good copper assets. I think we all understand that. I mean, at EMR, we are chasing copper every day, and suffice to say, it's very tough. And that really tells you that, good high-grade copper mines, large scale, long life, well, we like all those. How many of those are there on the planet? Not many. If you think about the copper basins, you got Australia, you got parts of Africa, right? Zambia, DRC. Then you got Chile. And if you think about all those places where you look for copper, none of them are, easy access during a pandemic or outside a pandemic, right? I mean, you look at Chile, the news about higher taxes, Leo, in the short term or in the long term, and you can see everyone trying to get a piece of the action. So I think it is a good space to be in for that reason, and very tough. I mean, a few years ago or 10, 15 years ago, we were all chasing 2% copper, right? And these days, 0.5 is pretty good. Find me one, and it's long life, large scale, we're going to go very, very hard at it. So I think that really tells you, and again, to your point earlier on about supply chains, Leo, I mean, we are seeing that people are trying to control their destiny and going upstream. So the other, aspect of raw materials is, is there a substitution risk? And that's a key element on how we would assess. And obviously with copper, you got multiple users. So it is not something that you could do without in the near, medium, long term, in our view. So certainly on the top of our list, amongst other things, Leo.
Mm-hmm. I mean, how high would the copper price have to be before threat of substitution came in?
Look, I mean, the thing about copper, obviously, it's got multiple users, right? So you can't actually substitute it easily in any situation, whether it's the grid, whether it's air conditioning, whether it's car, whether it's EV, whether it's new materials, new technology, energy transition, it's in all of those things. So it's not something that you could just have one size fits all, Leo. So I think our view is that we were positive. I think where it is today in terms of the price, I think it's got some way to go ultimately as supply becomes more constrained. I mean, if you look at any mines today, how hard is it to develop a new mine of any type, right? It's very, very tough. So it does mean that existing operating mines are valuable.
Absolutely. Luke, in terms of base metals, copper and the other base metals, where are you looking for opportunities? Where do you see them?
Yeah, we like base metals in general in terms of the fund that I run here at Ausbil with a colleague. Our core commodity exposures are base metals, namely sort of copper and nickel in particular. We own the battery material space as well, and oil and gas, but sort of our core exposures within the fund at this stage. It's sort of a bit of a generalization, but we own other commodities outside of that. But within the base metal space, copper's the starting point. Jason obviously touched on a range of factors that why everyone's got such a strong view around copper. I better watch what I say with Jason listening, but ultimately the outlook for copper from our perspective is quite positive. Not only do you have that backdrop around demand that I touched on earlier, you've also got a range of newer related demand areas, and in electric vehicles in particular, which in time will incrementally support demand. And then on the supply side, no one's invested in what they have, but there's been limited new investment in new major projects over the last 10 years since the last super cycle. We do have some of these projects coming through at the moment, but in terms of finding sort of moving forward the projects, developing. It's a long cycle to see new copper projects come online in a period where naturally, the existing projects, you're seeing grade decline and it's finite resource in general. And what's played out in South America over the last 12 months in terms of COVID and absenteeism, it doesn't just feed into a reduction in output for the last 12, 18 months. This feeds into longer term sort of production output for areas like Chile and Peru, where they've been mining hand to mouth, you'd call it, and therefore they're behind on strip and behind on those sort of activities that feeds into the copper thesis. Nickel thesis, it's probably more leverage to electric vehicles in time. It's dominated by stainless steel markets at the moment, but in time, of the base metals, clearly, the nickel space, given its implications in battery technology, is incrementally a supportive dynamic for nickel as well. The backdrop for nickel on the supply side is a little bit different though to copper. Clearly, we've got what is playing out in terms of NPI growth in Indonesia. Incredible what's played out there in terms of supply growth, and then that's now feeding into potential supply into matte, which may also feed into this EV demand as well. So the supply side's a little bit different on the nickel side, but the demand component over time will be somewhat turbocharged by what's playing out with electric vehicles, which we're highly positive on.
Absolutely. We'll get onto electric vehicles in a little bit. We're getting questions coming through from the audience here. One question here says, what precious metal do you see has the largest upside in price in 2021 and why? Which precious metal? So gold, silver, PGMs. Opinions on that, please.
Why don't I jump in? I don't know if it's worth picking out a winner, but maybe stepping back as to the drivers of precious metals in general. It's not just about supply and demand when you're talking about gold price, obviously, and a lot of financial drivers in particular really drive the gold price. And as a starting point, we've seen gold be extremely strong over the last couple of years and just come under some pressure over the course of the last 6 months. Still an exceptional price, from my perspective, in the environment that we're working in. This discussion around inflation is quite interesting in terms of what it means for broader commodities. I sort of touched on that at a high level at the outset. Gold, has a very high correlation to inflation. Traditional, sort of portfolios aren't set up well for inflationary backdrop. We haven't seen inflation, in my investing, sort of history. It's obviously been a very long time since we've seen it play out. But in general, gold is a very good hedge against an inflationary backdrop. So while the commodity's been under some pressure of late, given the move in bond yields in particular, and stepping back, the movement around growth and economic activity more broadly. But if we do see inflation continue to rear its head over the next 12 months, that feeds into a pretty positive backdrop for gold and precious metals as a starting point.
Absolutely. Got a question here about mineral sands, particularly zircon. Anyone have an opinion about mineral sands?
I'm going to jump in again.
Jump away.
Mineral sands quite interesting from the perspective. Again, it's not just a China story. The demand situation around mineral sands, rest of the world is very important. America, Europe in particular, it's quite a balanced demand backdrop. We've seen zircon and titanium dioxide feedstocks strengthen, despite the backdrop that we've been working through. That sort of backdrop that I sort of talked to in terms of the demand situation being, a rest of the world situation as well, unlike, the history, clearly feeds into, a positive backdrop for mineral sands and zircon in particular as well. So arguably, these sort of later cycle commodities, should see some support as we move forward. That the last 12 months, clearly, to my point, China-driven construction-related commodities, steel, iron ore, highly supportive from a demand perspective. The rest of the world starting to be a much larger component of the overall mix from a demand acceleration perspective, at least over the course of this year, feeds into a positive backdrop for mineral sands. It feeds into a positive backdrop for base metals, oil and gas, etc. So as a start, the demand backdrop is supportive.
Absolutely. You expect sort of rutile to titanium dioxide sort of going into all those paints as everyone starts getting out there and building stuff again. Absolutely. A question here about container shipping prices. And I guess, they're very high at the moment. Clyde, you look at this, I know, a lot. What are your thoughts on why they're so high, where next on that? And is that potentially sort of going to be a threat to the recovery a little bit?
I think it feeds into the sort of more generalized inflation story. I mean, you probably saw quite a bit of container capacity come out of the world fleet during the sort of COVID lockdowns last year. So now you're struggling to put that capacity back in, and you're struggling to have it meet demand. As you said earlier, there's a lot of focus on this as a sort of, if you want to put it, a home body led recovery, people spending money on their homes, buying things. A lot of that stuff is shipped in containers, televisions, white goods, etc., etc. So it's an understandable kind of boost to that. So how quickly can the shipping industry catch up to demand? Not terribly. That's always the problem with these things. It takes a little while for them to get back to the amount of ships that they had before, to bring them back if they've sort of put them into storage. It's not that easy. You also have, with the sort of the fuel costs rising, particularly as ships now have to use a much more sort of cleaner burning, either fuel oil or marine gas oil or things like that. So the operating costs are going up, and that's also feeding into the sort of inflation calculation on shipping rates. So again, I think you've got quite a positive background there for at least a continuation of the rally. But certainly no signs of any retreat, I would think, in shipping rates for the time being.
Absolutely. And a point you touched on there in terms of the sort of the emissions that shipping gives off, this sort of brings us nicely into another question here about how much influence will ESG have on commodities in terms of investment from the growth in ESG funds. So, all of the funds are looking to improve their, investments into their ESG. So how is that going to impact investments into commodities, do we think?
Yeah, look at the macro level, as we're seeing this energy transition play out over the medium term, clearly there's commodities that, structurally challenged with that backdrop, and fossil fuels is the starting point. Clearly coal, thermal coal in particular, is at the pointy end of that, but clearly the fossil fuel space in general will get hit over the medium to longer term in terms of demand destruction as we see this energy transition play out. But these key macro ESG trends, and there's more to ESG than the macro, feeds into a range of themes that are metals intensive. And if it's renewables, if it's electric vehicles, if it's hydrogen, there's a range of commodities that are massive benefactors on the back of those key themes. Most obviously at the pointy end being lithium, graphite, sort of high grade manganese as a starting point around sort of electric vehicle uptake. Secondly, renewables feeds into rare earths, feeds into silver to some degree as well, and then hydrogen clearly feeds into PGMs as well. So Interestingly, resources, there's this perception that that it's a dirty word, but these themes that are playing out to green, the world feed into massive demand at the specific level around certain commodities, and then they also feed into base metals as well. I touched on some of that in prior comments around copper and nickel and the benefit there as well. So at a macro level, some of these large scale ESG trends are clearly feeding into commodities. Then how does it feed into ESG funds? Interestingly, in terms of the some of the exposures that we have in that space, we are seeing these ESG funds starting to enter the space as well, and that might be in the lithium graphite space that you see these ESG funds are buying into these companies as well. That they're we're also seeing companies focused much more around ESG as a whole, to make themselves be more investable to a broader universe. One, the generalists, two, the ESG funds. You're seeing more green copper companies, copper companies being more focused around how they generate the copper, and that's definitely a theme that is only going to improve, one, the companies, two, their access to capital in time as well. So it's probably a long-winded answer, but there's a range of factors that are definitely related to ESG as a whole.
Absolutely. And you mentioned sort of green production of copper. A lot of people looking into green production of steel as well, which obviously has big implications long-term for the coking coal market. If we could just, the energy transition obviously is something that a lot of people are talking about. But in terms of the rally to date, how much of that is due to the energy transition and people using more materials to build wind turbines and the like, and EVs, and how much of it is just the supply side shortages and the bounce back after COVID? Are we yet to see any impact of the energy transition?
Well, I would think the energy transition is, at the moment, I would say it's still probably a marginal driver of extra demand. You starting to see, in the nickel space, yes, most of it goes into stainless steel, but there is an ever increasing share going into batteries and that sort of related technology. So I don't think it's now the main driver. What it is it's an attention grabber. And it gets a lot of people interested in what's going on. So I think, as Luke said, the ESG movement is not going away, and there are going to be a lot more people, under pressure in companies that are sort of polluting in the way they extract resources to green up their act. Now, they can do that in a variety of ways. I think the most common way that a lot of oil and gas companies are going to try and do it is by purchasing carbon credits, growing forests and things like that. So, you probably find that there are people who do forest plantations who are going to start to see more business coming their way, that sort of thing. But you are going to see, I imagine, an increasing shift to people thinking about this and how they're going to manage it. You can't really offset iron ore, producing steel using coking coal. Yes, you could try and do electric arc furnaces and innovative technologies. That's still some time away. I'm not saying they won't come, but it's not coming right now. What you can do right now is stop using diesel at your mine sites. You can electrify, your transportation chains. You can buy carbon credits. These are the sort of things that companies are going to do. The idea of a company like Woodside selling, green LNG. I mean, the gas companies are now, they saw what happened to coal. They know that the people who are anti-coal are now coming after them. I speak to a lot of green environmentalists, on the sort of what one might call the more sensible side of that spectrum. And, they see gas as just a bigger problem as coal. And they feel that they're winning against coal, and now the fight is moving to gas. So I think, there's going to be an increasing focus on how companies manage these sort of risks.
So in terms of any potential boost in commodity space from the energy transition, that is yet to come.
Well, I think it's starting to come, but I think your bigger boost is yet to come. There's still, electric vehicles are still, in percentage terms, a very small part of the global market. If you're sort of talking of net zero by 2050, they're going to have to become the majority of the market. That's going to be an enormous shift. And they have to get a lot cheaper, and they have to have a lot of these things have to change quite quickly in order to tempt the populace to do it. I mean, if I wanted to buy an electric car in Australia, I can, but they're incredibly expensive. There are no value equation, no benefit for me. I can buy a much better car with an internal combustion engine for the same money. So there's got to be a change in incentives and things like that. So I think we're at the start of that process. But if you're going to change the electricity system globally to be sort of 80-90% renewables, think of the vast amounts of solar panels, all the silicon, all the steel, all the copper, all the stuff that goes into those panels. Think of the wind turbines. Again, there's a lot of steel intensive. Think of all the sort of new transmission cables and things like that, inverter technology. It's utterly huge. And if you are genuinely going to do this, and I still don't think it's necessarily a given, but I think a lot of companies and countries are going to try. And if we do go down that road, there's going to be an incredible call on a whole range of metals. And that's going to be interesting itself, because greenies also don't like mining. They want all this to sort of magically happen without the sort of digging up of large parts of the Earth's crust. So it's, there's a lot of challenges.
There's lots of information out there which shows that, to achieve all of the transition that we need, there's going to be there's not enough metal around presently, so we need to get investing. Uranium, potentially a beneficiary of energy transition. How's that market looking at the moment?
Does anybody?
Sounds like me.
Silence. Luke.
Well, yeah, I guess bringing it all back to it, renewables. Battery storage isn't a point that renewables can't have. They need baseload power gen, I guess, is the point that I'm badly trying to explain, right? Is that, while we're seeing an acceleration of renewables more broadly, battery storage isn't at a level where you can't have baseload power gen in the mix. And if you step through the different types of, fossil fuels, and Clyde touched on this as well, is clearly coal's on the nose. Seeing that start to transition out. Gas is sort of a transition fuel, but again, there's a view that it's still starting to shift out as well. The cleanest form of sort of baseload power gen really comes back to nuclear, and ironically that's always been on the nose for some time as well. Sort of Fukushima doesn't help things as a starting point as well, but. Look, the uranium market's seen a number of cycles in the last sort of 10 years in itself, and now we're starting to see potential producers raise money and stockpile uranium on spot. You're seeing the market start to tighten. That's sort of at the margin from my perspective. Really it's the term market that matters. It's a long-term market, with the utilities that really drives uranium, and it's taken some time to turn. We're probably close to that point. With the amount of nuclear growth that we're seeing out of China and supportive policies in the US as well, but. Look, it's taken some time, and we're not quite there yet as well, because sure you can see stockpiling play out by the potential producers, but as Cameco have highlighted, there's a number of projects low on the cost curve that are able to be restarted as well. So look, I think there's a place for uranium. I think we will see over the medium term uranium markets strengthen in time. In time being the operative word, but ultimately it's going to take some time.
Yeah, it's brave person to predict that turn, or the turn in any market, to be honest. I mean, I remember people talking to me about uranium back in about 2013, 14, saying, yeah, it's definitely turning now. We're on the up. We've sort of running out of time. We've only got a couple of minutes left, but if I could just end this with getting our panelists to sort of pick their commodity of 2021. If you feel free to go with the ones we've had already. Feel free to pick one out of left field. If we could let's start with Jason.
Yeah, I think if you just listen on all the commentary, I think there's a common element there, that's copper, fundamentally because of the demand, multi-uses. I mean, we haven't even talked about, health uses for copper. I think, you're going to find that copper will extend its usage into a whole range of other things, and supply is tough. So I think our pick very much would be copper. Absolutely.
All the sort of antibacterial properties of copper and things like that obviously play well, following the recent situation. Luke, your thoughts?
Yeah, let me throw out a different one. Lithium. I sort of highlighted that some of our core exposure in the fund that I run is in the battery material space. What we've seen, over the last 12 months or so is a real acceleration in EV penetration. One, it's China as a start. China's always been, at the forefront around EV penetration, but sort of real acceleration, post-COVID in the first quarter, from the late first quarter of last year. But then this green stimulus that we're seeing being injected into Europe in particular has seen a massive acceleration in penetration in Europe around EV uptake. And look, all of a sudden Europe is larger than China in terms of the overall EV market. So we're seeing some major acceleration in demand around battery materials in particular, and clearly lithium's at the forefront of that. And for the last 4 years, we've seen no investment in new supply because we've been in the doldrums and the lows of the cycle. So I throw out lithium. We've already seen a recovery in the commodity over the last 6 months, but I expect that's just going to accelerate over, excuse the pun, over the course of this year.
Clyde, what's your pick?
Well, if you'd asked me this 3 months ago, I would have said iron ore, but I think iron ore's had its run. I can't see it continuing, working on the assumption that we do get more supply out of Brazil and Australian producers are able to maximize, their mines as well. I can't really see iron ore, rallying strongly from where it is. Not picking a collapse at all. A sort of left field one is, I kind of like gold for some reasons. I mean, I think the inflation correlation, we are starting to see a lot more commentary about inflation worries. And the other thing is, if you look at the physical gold market, 50% of that is two countries, China and India. And that demand has been somewhat constrained by COVID, particularly in India. So if you're working on the assumption that India manages to get itself sorted by the end of the year, I think you could start to see quite a strong rally in physical in gold, because there's a lot of pent-up demand in India that has not been able to be met. And they have a very strong cultural affinity for gold for a whole range of reasons. And you tend to see a lot of those reasons, like weddings and festivals, coming in the fourth quarter. So if you are starting to sort of think of a positive gold story, if you get the physical driver of people in India and to a lesser extent China actually buying it again, you get the inflation story coming through, which drives a bit of investment purchases. I think the possibility that gold resumes its rally is pretty high.
Absolutely. Quick question. I mean, you mentioned iron ore just now, but quick question from the audience here, and I think this is worth answering actually, which is what if China decides to buy iron ore from Brazil? So the idea being, they say, right, we're not going to buy iron ore from Australia. We're going to buy all our iron ore from Brazil. What would happen?
Well, as Luke says, they already are. They're buying as much from Brazil as they possibly can. Yes, Brazil does supply some to particularly Europe, which makes sense from a geographic location. But the vast majority of Brazilian iron ore heads towards China. So Yeah, but even if you look at it, Brazil's top output per month at the moment is probably about 35 million tons. That's what they can do. So if China bought all that 35 million tons, and let's assume it bought the 4 or 5 million tons from South Africa and another couple of million tons from third-tier producers, Iran, India, and whatever, the best they can get to is about 45, 50 million tons. They're importing 100 million tons a month. That's your question. They just cannot.
Yeah. Well, the discussion around iron ore market is interesting, right? These prices, it's surprising that we haven't seen that incentivize, as much of the non-traditional players, as we've seen historically. And we're starting to see a bit of that at the moment. Like India's ramping up exports. The Chinese supply seems to be finally responding. That used to be a major source of supply, and this whole discussion around China-Australian relationships. Look, clearly in time, China will want to reduce their reliance on Australian imported iron ore. To the point at 60% of last year's demand overall. At the moment they're changing policies at the margin, trying to reduce exports, so that the iron ore consumption in the steel market is directed towards their own economy. They're trying to incentivize scrap imports. They reduced the restrictions on scrap imports recently. That hopefully should start to see increased ferrous imports into China as well. Not helped by the fact that ferrous scrap is exceptionally high as well. And the discussion around Simandou, clearly in time, similar in what they did with bauxite. The world will be surprised how quickly the Chinese can develop iron ore in Africa. From my perspective, and we saw what they did in bauxite. Ultimately, what it comes back to is that there's been a raft of supply issues in the iron ore market. Demand has been extremely strong, but this reliance on Australian ore is not going away anytime soon. But there's a number of policies that will look to change that over the medium term.
But this is, I guess, true across many commodities, that the supply demand sort of it's fairly much in balance across most commodities, and it's not that simple just to say, okay, I don't want to buy my iron ore from you, I'll buy it from someone else. Or if you're wanting to build wind turbines, for example, and you need magnets, rare earths for your magnets, just to say, get me some magnets, get me some rare earths, or get me some lithium for my cars.
So supply and demand always balances. As price is the solving item, right? And we're seeing in price that things are tight in the market, demand's strong, supply's struggling, supply hasn't seen any investment, demand's only improving. Price is the solving item, and that tells you that this market is tight across a number, if not all, of these commodities.
So basically, long story short, we need more investment in mines, more mines, and the prices are going to stay higher for longer, I guess. Would that be the sort of consensus of the panel?
Yeah, I think that's a general theme, Leo, because supply, ultimately is getting harder, and it's quite obvious. I think there's only, I think the general market is starting to acknowledge that, and that's why we're seeing a bit of a ramp up, in prices. But a lot of the supply side guys will say, well, we should have been here a while ago, right? There just hasn't been a recognition of that. So we are positive on that outlook. I mean, again, driven by demand, supply. Demand's going pretty well.
And one final thing, actually, and this was a question that was sent in prior to the panel, in terms of charting a super cycle, in terms of looking at the signals we should be looking out for when things are off and running and when we're reaching the top. What would be your tips on, for example, how do we know when we're in the next super cycle? And then what are the signals that we should start to think about getting out of it?
Oh, I think we're in it. I think we're seeing all the signals already. And as a start, super cycles is about demand. That it's not just about supply. Supply, is helping the narrative as well. But this demand backdrop is extremely strong, and like I said, China's the backbone to that. Rest of the world, vaccine plus the acceleration around stimulus feeds into that. It's arguable, but we're in it. You can see it in terms of pricing. How do you know when you're at the peak of the super cycle? The majors start buying assets. We haven't seen the likes of BHP and Rio. They've been quite conservative in terms of what they've done to date. It's been focused around balance sheets, returning capital, shareholders. You'll know you're at the end of the super cycle when we start seeing the M&A transactions again. That's when you probably start being concerned from my perspective.
The big mega mergers. Clyde, your thoughts?
Actually, I'm not so sure we'll see the big mega mergers, and not least for a while. I think the super mining majors certainly got stung a lot for their behavior during the last sort of boom from 2008 to 2011. And where they invested a lot of the money that they had in building up capacity and collapsed prices. So I think they are extremely cautious. I also think the shareholders of those entities are now very, very happy at the idea of getting lots of capital returned to them. I mean, if it's costing you $15 to get a ton of iron ore to a ship in the Pilbara, and you're selling it for 230, you are generating cash at an enormous rate. And that is true for not just iron ore producers, but for a bunch of other commodities. So I think there's a lot of pressure on those companies to make their shareholders rich this time, because that they stuck with them through it. They didn't like what happened the last time, and they're wanting a different outcome. So I'm not sure we'll get it quickly. I'm not saying we won't get it at all. But yeah, so for me, when I think when we're getting to the top is when I do start to see, the brakes being put on the world economy, because that will ultimately put the brakes on everything. So when you start to see the major central banks around the world start to raise interest rates, when you start to see people getting really concerned about inflation, when you start to, when that narrative that we read every day in the media and on the websites and whatever, when that changes, that's when I think we're getting ready to be near the peak. The good thing for commodities is they're generally the last thing to peak in these sort of scenarios. So, there's still clearly a lot of headroom. And for commodities which are going to be needed in the energy transition, working on the assumption that this is a real thing, which I think it is, but at the moment I'm not seeing, the evidence is still mixed, let's put it that way. I think they're going to do incredibly well. And I think you had the boss of Glencore saying that the copper price would have to double. I don't want to misquote him, but it was maybe it was 50%. But either way, it was an enormous increase in order to incentivize production. You can see that sort of thing happening. Massive price increases also do tend to lead to innovation and people doing different things, recycling, alternatives, etc. But you will have that period where a lot of commodities are enjoying strong demand and restrained supply, and there's nothing that you can do about that other than adjust through pricing.
When do you think, given that I mentioned at the beginning that sort of soft commodities, things like soybeans and corn and stuff are all up as well. At what point do you think the sort of central banks will start to get concerned about inflation?
That's always a hard one, because you get quite different signals from the various central banks. I think when you start to see inflation sort of consistently print above 3% in developed economies, so the US, the UK, I think then you'll start to see a little bit of concern about that. It will all depend how things are matched with wages growth. We do know that one of the great ways to get rid of government debt is to inflate it away. So there might be a temptation on the part of governments to do that, to sort of say, oh, well, we've got so many trillions worth of debt, we'll just kind of let it inflate away. But the last time the world tried that, it was not a happy outcome, and it took a long time to recover from it. So you never know. My feeling is that you'll start to see gradual tightening, probably too late. It does tend to be that the central banks leave the punch bowl out at the party for too long and then take it away suddenly, and then everybody crashes.
Absolutely. Well, okay, so we've sort of run out of time there, unfortunately. We could go on. There's lots of commodities we didn't really cover. Potash. I know, Jason. You guys were with your Highfield project. That's another one we could have touched on, but we run out of time, unfortunately. But thank you very much for all your insights there. Thank you very much to everyone who asked questions. We had a whole load of questions come through there. We weren't able to get to all of them in the time that we had, but this is an ongoing conversation. We'll be back. Having fairly regular webinars over the next few months to talk about this sort of thing. So please do join us again for those. And a reminder for those of you who are interested in meeting with some of our companies at the upcoming one-to-one mining investment APAC event on the 16th to 18th of June. The meeting planner will be opening next week, so please do sign up for that on our website. We will send you your logins for the meeting planner. But otherwise, have a wonderful weekend and good luck investing in the commodities space going forward, if that's what you choose to do with your time and money. Alrighty, well, thank you very much, everybody.